If you watch my channel on a regular basis, I'm assuming that I don't have to convince you that dividends are a great way of giving your investment portfolio a boost of passive income, which is something that a lot of people are looking for during periods of high inflation and amid talks of a possible recession. And with stocks falling hard last week, it's created a great opportunity to pick up great companies at much cheaper prices and thus offering a higher yield on your investing dollars. But given the market sell-off last week, what we've been seeing is some stocks and funds now offering yields of over 20%. This can potentially be a great buying opportunity for investors looking to maximize the amount of dividends they can get for their money. But we have to make sure that at the same time, it's important not to chase stocks simply offering the highest yields. My general rule is that anytime a stock or a fund offers a dividend yield of over 12%, I always exercise extreme caution. That's not to say that I'm not always cautious and I don't always do my research, but the higher the yield, the more research I tend to do in a particular company because I need to find out if that company's dividend is going to be sustainable. But with nearly all companies, once you go over a 15% yield, it tends to be a dividend trap. These investments usually have a history of consistent dividend cuts. But today we're going to look at one investment in particular that a viewer requested that stands out from all the others I've seen. This company currently yields over 20% and they've grown their dividend every year for the past 4 years. The stock we're going to be examining is OFS Credit Company, ticker symbol OCCI. They're a non-diversified closed-end management investment company that was founded back in 2018. The primary goal for this stock, according to their website, is to generate current income, with the secondary objective being generating capital appreciation primarily through investing in collateralized loan obligation, or CLO, equities and subordinated debt securities. OFS Credit was launched by OFS Capital Management, which is a full-service provider of capital and leveraged financing solutions to U.S. corporations based out of Chicago. They were established back in 1994 and have approximately $3.1 billion worth of assets under management. As you can see, according to Google, their stock currently offers investors an incredible 20% dividend yield. For this reason, I've been seeing some people asking what this stock is because it is kind of a difficult investment to explain, especially if you're not too familiar with CLOs and closed-end investment companies. It involves some pretty complicated types of investments that most investors aren't exposed to. But I'll break down everything you need to know about this stock and provide you with enough information to determine if this is the kind of investment that you might be worth considering, and I'll give my own personal opinion on it after we look at everything. So I think the two biggest things to take away from this stock's description that we need to focus on is closed-end investment and collateralized loan obligations, and I'll start on the former. OCCI isn't like your typical stock like Ares Capital or Sachem Capital. OFC Credit is what's known as a closed-end fund company, which is a publicly traded investment that invests in a pool of securities such as stocks and bonds. In a lot of ways, it's a lot like an ETF or even your typical mutual fund, but there are some important differences. Each closed-end fund is a separate company. So for example, with Vanguard, they own a lot of ETFs like VNQ, VCI, and etc. All of these funds fall under the Vanguard group. But with closed-end funds, each fund is owned by its own separate company. There may be one larger company, like PIMCO has lots of CEFs, but each one has its own management group. This chart that I've used in a few previous videos gives a really good breakdown on what the main differences are between an ETF, a mutual fund, and a closed-end fund. Closed-end funds like OFS Credit are actively managed, unlike most ETFs that are passively managed. Because of this, they often charge much higher expense ratios than an ETF and a mutual fund, usually over 1%, if not higher. There's also a fixed amount of shares of a CEF because they have IPOs just like your typical company stock, so this is another way that CEFs differ from ETFs and mutual funds. Another way CEFs stand out is that they use leverage, and sometimes a lot of leverage, which I'll touch on later in this video. But all three types of investments are structured as pooled, diversified investments. The other takeaway from this fund's description is that this fund holds CLOs, or collateralized loan obligation, equities. I'll do my best to explain these complex investments as easy as I can, but CLOs are basically a pool of leveraged corporate loans that are bundled together and put into equity securities, which funds like OCCI buy and put into their fund. If you regularly seek out high-yielding investments, you might be aware of some other CLO funds because they almost always offer dividend yields of over 12 to 15%. Two popular CLO funds out there include Oxford Lane Capital, ticker symbol OXLC, and Eagle Point Credit, which is ticker symbol ECC. These types of funds tend to make investors sweat because if you've ever seen the movie The Big Short, an alternative to the CLO, known as the collateralized debt obligation, was very negatively portrayed in this movie. If you remember the scene where Jared is explaining CDOs to Mark Baum and his team, you'll know that these obligations operate using a series of tranches, all of which carry ratings by various rating agencies ranging from AAA and all the way down to D, or even carrying no rating. To put it as simply as I can, the corporate debt inside of CLOs that OCCI invests in are ranked based on their perceived ability to repay their loans. And the truth is that these funds like OFS Credit Company, Oxford Lane, and Eagle Point After Invest in are very poorly rated. Because interest payments are much higher on lower rated debt, that means that CLO funds can pay higher dividends to their shareholders, which helps explain OCCI's massive high dividend yield. Now, my goal for this video isn't to try to explain everything about CLOs because it would take a really long time, but hopefully this gives a decent enough explanation as to how these things work. While these types of investments do scare a lot of investors, there are people out there who do advocate investing in them during certain economic times for a few reasons. They're a pooled investment which helps for diversification's sake, and unlike the CDOs and the Big Short which dealt with consumer mortgages, the debt inside CLOs are first lien senior secured debt, which is something you'd find in a business development company. And the recovery rate if a company can't pay its debt is 76% according to Fitch ratings, so it's extremely rare that one of these loans would be a total loss if the company couldn't repay. But with that explanation out of the way, let's go ahead and take a deeper look into OCCI specifically. As you can see, it currently yields over 20% according to Google, and just by looking at their dividend distribution history, we can see that they've actually been able to grow their distribution since their inception. It actually used to pay monthly dividends, but they switched to quarterly distributions back in June of 2020. But at the same time, if we extend the share price performance of OCCI since their IPO, we can see that the share price for this fund has dropped by more than 43% in less than 4 years. So what on earth explains this dramatic share price fall? There's one thing that I found particularly scary inside of OFS Credit's semi-annual report that came out not too long ago. On page 6 it states, the CLO securities in which we primarily invest are unrated or rated below investment grade, which are often referred to as junk securities. In addition, the CLO equity and subordinated debt securities in which we will invest are highly leveraged, with CLO equity securities typically being leveraged 9 to 13 times, which magnifies our risk of loss on such investments. If you're not familiar with leverage, that's an extreme amount of leverage, and the more leverage an investment has translates into higher risk. So even compared to other CLO funds out there, OCCI might be the riskiest one you can possibly find. Just by going through their latest investment fact sheet on their website, we can see that OCCI holds a lot of this higher risk debt. They don't hold anything A-rated, and the majority of their investments are in very low B-rated debt. A little bit of C-rated debt, and then 3.7% in debt that's not even rated, so who knows what that's in. But as I previously mentioned, the higher the risk, the higher the investment payments these companies have to make, which explains the massive dividend yield being over 20%. But OCCI is also the smallest CLO fund when compared to Oxford Lane and Eagle Point, meaning that the more companies that default on their loans means the larger the negative impact it'll have on this fund. We need to address another negative here that's not just with OCCI but with every CLO fund. All of these funds, including Oxford Lane and Eagle Point, charge investors huge fees. According to Morningstar, the average ETF expense ratio in 2019 was 0.45%. For index ETFs, the average expense ratio was 0.2% according to Investopedia. For all closed-end funds, the average expense ratio is 1.09% according to Kiplinger. But for OPS Credit, their fund charges an expense ratio of 12.1%. That means for every $10,000 you invest in OCCI, $1,210 is going to be eaten up by fees. This is probably the highest I've ever seen for an investment, at least an investment that's traded on a public exchange. But this is actually pretty comparable to Oxford Square and Eagle Point. Anytime you have an actively managed fund holding these really complex investments, you're going to see some pretty sky-high fees associated with it. But you could argue that all of these fees might actually be worth it if the investment is providing superior returns. Like for example, if I was getting an outrageous return on my investment, something like 30% annually, then sure, I'd consider a 12.1% expense ratio. It might actually be worth it. But judging by the dramatic share price fall of OCCI, it's not translated into a worthwhile investment up to this point. This is where using a drip calculator comes in handy. I use this tool in a lot of my videos to see the total return of a stock, an ETF, or a closed-end fund. It's a really good tool to show how well an investment has been able to treat investors. And although past performance never guarantees future performance, I still see a lot of value in how an investment has performed historically. I tend to use this knowledge as a roadmap to determine how I'm going to proceed with analyzing an investment. But we'll take a look at the total return of OCCI since its inception in 2018, and we'll take into account the dividends and see how well this fund has performed. Over the last roughly 4 years, this fund has given investors a pretty disappointing return. A $10,000 investment into OCCI back when this fund was first launched, you'd currently be underwater at an investment total of $9,918.49. And remember, this is with all those sky-high dividends being reinvested. Your starting shares of 533 would have turned into 939 shares, which is a huge increase in less than 4 years, but it's clear that the free-falling share price is the main issue with OCCI. Your total return would be minus 0.8, which translates into an average annual return of minus 0.21%. So it's clear up to this point that OCCI hasn't been performing too well. But going forward, if we actually are headed for a recession, which it looks like we are, how do CLO funds perform in general? Are they better investments? Are they worse investments? How do they typically perform during market turndowns? Fortunately, Eagle Point Credit Company has a chart in their latest investor presentation that shows how well CLO equity funds have been performing over the last 30 years. This chart shows the total return of the Credit Suisse Leveraged Loan Index, or CSLLI, and we can see that the future looks pretty mixed for CLL funds if a recession is in store. The reason I say that is during market turndowns, if we compare CLOs to the S&P 500's performance, CLO equities do tend to perform a little better than the market. For example, if you notice in 2008, CLOs had a loss of 28.8%, which isn't good, but that same year, the S&P 500 lost 38.49% according to macrotrends.net. In fact, this year, CLO equity is only down about 2.7% compared to the S&P 500 currently being down about 15% for the year. But keep in mind that this is the performance of the index. OPS Credit invests in CLOs that are much riskier than average. If OCCI mirrored what's in the Credit Suisse index, then it could be a potentially worthwhile investment. But in reality, OPS Credit invests in equities that are riskier than other CLO funds. So to summarize things, despite the incredibly high yield, when we take into account the share price performance, the expense ratio, and the risks involved, OCCI is an investment that doesn't look good to me. As always, you're free to disagree, but that 20% dividend yield just isn't worth it in this situation. You're going to be paying sky-high fees while losing a lot of your initial investment. I'll continue to keep my eyes on this fund, but I don't have high hopes for a turnaround here, at least anytime soon. And as always, be sure to perform your own research and due diligence and come to your own conclusion before making any investment in any security. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below and also subscribe to the channel if you want to see more high yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. All right, thanks again guys so much for watching, and until next time, take care.